Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Palo Alto network stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 74 billion market cap. They're trading at $2.41 a share, and they have 306 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow looks really good. It goes from 800 million to 2.8 billion in 2023. They just completed their 2023 fiscal year. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's negative each year, except in 2023, they did have a positive 700 million. It looks like they passed through lots of write-downs, probably asset impairments. Revenue is a sales for the company, and that doubled from 3.4 billion to 6.9 billion. So their financials look pretty good. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 99 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $86 billion. We divide that by 306 million shares. And we get a calculated stock price of $281. They're trading at $241, so they're trading at a 14% discount. It is a buy according to the model. The company is expected to grow a lot in the next few years. So if that happens, the stock does seem undervalued. But of course, there's no guarantee that will happen. There are 141 companies in the same industry as PANW, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 148 million in CapEx, lower than the average, higher than the median. Microsoft spends the most at 28 billion. The company is really leveraged. For every dollar of equity, they have $3.20 of debt. They don't pay a dividend. They generate lots of free cash flow, 2.8 billion. They rank 4th in market cap. They should be up here, not number 6. All their price multiples are worse than average. This implies investors think the company will grow a lot in the future. That's why they're paying such a high price for the company. They generate 7 billion of revenue, which isn't a ton, but it is higher than the average. But they're still growing a ton, 25%. That's their 5-year annual revenue growth rate. Look at Zscaler. They're at 54%. MongoDB 49%. They just released their 7/31 results. They beat earnings, just missed on revenue. Their earnings expectation was 129. They reported 144, so they beat it by 12%. And they just missed revenue by 100 million. They reported 1.95 billion. But for the prior 3 quarters, they beat earnings and revenue. They've only done one stock split last year, a 3-for-1. If you put $10,000 into this company 10 years ago, you'd be really happy at $148,000 today. That's a 31% annual return, almost a 1,400% total return. Let's take a look at their earnings slides for the 4th quarter of 2023. Revenue of 1.95 billion, up 26% from the same time period last year. Operating margins up 7.6% to 28.4%. Operating margins, operating income over revenue. It's how well you convert revenue into operating profit. They had total billings of 3.16 billion. Because not all their billings are revenue. Sometimes it's carried on the balance sheet as unearned revenue. They can't record the revenue until they provide the product or service. And their trailing 12-month free cash flow is up 46% to 388 million. Earnings per share of $1.44. That's net income over shares outstanding, up 80% year over year. And they beat their target in every category. Total billings, 9.19 billion. The target was around 9 billion. Total revenue of 6.89 billion. That's the higher end of their guidance. EPS, they crushed their guidance. The higher end was 317. They were 444. A really solid free cash flow margin of 38.8%. That's free cash flow over revenue. These charts are their quarterly numbers, the past 5 quarters. They had their highest revenue ever, nearly 2 billion. For the most recent quarter, a big jump from last quarter of 1.7 billion. Their revenue growth is about 25% every quarter. And they also had the highest total billings this quarter, 3.2 billion. That's only up 18% because they had a really big number in the 4th quarter of 2022, 2.7 billion. Margins are really improving. In 2020, 18%, 2021 and 2022, 19%. For 2023, it's 24%. Lots of companies are getting squeezed, but their margins are going up. And it looks like their deferred revenue is growing a lot, their highest ever. These bars represent the percent of their bookings on deferred payment plans. And that's what you want. You want people to pay upfront on a plan. Recurring revenue is the heart of a lot of businesses. Here are some of the guidance for 2024. Total billings 11 billion, revenue of about 8.15 to 8.2 billion, operating margin 25%, EPS about 530, and adjusted free cash flow 37%. Let's look at the company on Simply Wall Street. Last price $235, 72 billion market cap. The stock is up 9% in the past week, up 24% in the past year. Let's learn a little more about the company. They provide cybersecurity solutions worldwide. They offer firewall appliances and software. One of their products is Panorama. They also provide subscription services covering the areas of threat prevention, malware, URL filtering, laptop and mobile protection, and DNS security. Subscriptions also cover IoT, Internet of Things, SaaS API, and data loss prevention. They also offer cloud security, secure access, security operations, and threat intelligence. Professional services including architecture, design and planning, implementation, configuration of firewall migration, education services such as certifications, also online and in-classroom training. They sell their products through their channel partners, also directly to medium to large enterprises, service providers, and government entities. The industries that buy their product are education companies, energy, financial services, healthcare, media, manufacturing, the public sector, and telecommunications. They were founded in 2005, a pretty young company, headquartered in Santa Clara, California. The two risks they list are insider selling, and shareholders have been diluted in the past year. The stock has done amazing since they started trading. It pretty much only went up. In mid-2022, it was over $200. Then it fell to $135 in the beginning of this year. Their peak was $258 in July of 2023, so about 6 weeks ago. But it hasn't come down that much since the peak. It's trading at $235. Simply Wall Street is really bullish. They're at $467. They say the stock is 50% undervalued. 39 analysts priced this stock at $273. They also say the stock is really undervalued. Look how much they've grown since 2012. Their revenue was $284 million. That's still a lot of revenue. Imagine having a company with that much revenue in a year. If you had a company with $1 million of revenue in a year, you'd probably be pretty happy. You can see they grow every single year. Let's see when they hit 1 billion. It was in 2015 when they first broke through 1 billion. That's revenue for the trailing 12 months. Let's see how long it took them to double that to 2 billion. So from 2015 to 2018, so about 3 years to get to 2 billion. Let's see how long it took them to double it from there to 4 billion. From 2018 to 2021, 3 years to double to 4 billion. And look how much it's shot up since then. It's almost 7 billion currently. Their forecast by 2026 is 11.5 billion. They were debt-free in 2013 and 2014. They took on a little debt. Then in 2018, they took on a lot more debt. It was close to 2 billion. They paid it down in 2020 to 1.5 billion. Then they took on more debt. It's currently at the highest point at 3.9 billion. But this blue line is their equity balance, which is a lot lower than their debt. That's why they're really leveraged. Their debt is so much higher than their equity. But when you look at the green line, their cash balance, it's not really a concern because they have a ton of cash on their balance sheet. If they wanted to, they could pay off all their debt. But they probably don't want to. They'd rather reinvest back into the company to grow it. They're growing at a 25% clip. The debt is probably only 3, 4, maybe 5% tops. Nikesh Arora, the CEO, annual salary $250,000, total compensation $10 million. He's been CEO a little over 5 years. In the past year, there's been lots of insider selling, no buying. That's not what you like to see. You want to see buying, not selling. So every quarter, someone sells. If we sum up these numbers, it's about 400,000 shares that have been sold. 90% of the company is held by institutions, 8.5% by the general public, and 1.3% by insiders. Vanguard is their biggest shareholder at 8.5%, then BlackRock at 7.3%, JP Morgan at 1.25%, Goldman at 1%, Invesco at 0.75%, the giant French bank SocGen, they also own 0.75%. Merrill's on here, BNY Mellon. They employ lots of people and their employee count has been going up, 847 in 2012. It's currently at 14,000. And the ticker trades in a bunch of places: the Nasdaq, Deutsche Börse, Zicha, London Stock Exchange, Mexican Bolsa, Wiener Bourse, Sao Paulo Bolsa, and Buenos Aires Stock Exchange. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.